Definition of currency risk. Currency risk, also known as foreign exchange risk or FX risk, refers to the financial exposure companies face due to fluctuating exchange rates between currencies. This risk arises when companies engage in international trade or maintain assets or liabilities in foreign currencies. Even small movements in exchange rates can significantly impact the value of these assets or transactions, potentially leading to financial losses. A prime example of this was the impact of the Brexit vote in 2016, which caused the British pound to plummet by over 10% against the US dollar overnight, creating a financial storm for UK-based companies trading in foreign currencies. Importance of managing currency risk in corporate finance. Effectively managing currency risk is critical to maintaining a company's financial health. Currency volatility can erode profit margins, disrupt cash flows, and impact a company's competitiveness in global markets. For example, Apple Inc., which generates over 60% of its revenue outside the United States, employs sophisticated FX risk management strategies to hedge its exposure to fluctuating exchange rates. By doing so, it shields its revenue from unpredictable currency movements, ensuring profitability even in volatile markets. The increasing pace of globalization makes exposure to currency fluctuations almost inevitable, and failure to mitigate these risks can result in substantial financial losses. Overview of rule-based decision-making. Rule-based decision-making involves establishing predetermined guidelines for making financial decisions. In foreign exchange, this approach ensures that currency transactions are based on objective, strategic criteria, rather than instinct or market sentiment. This reduces the risk of emotional decision-making that can often exacerbate losses during volatile market conditions. One notable example is the use of algorithmic trading systems by large corporations. These systems automatically execute currency transactions based on specific rules, such as purchasing foreign currency when exchange rates reach certain thresholds. Application in foreign exchange transactions. In the context of foreign exchange, rule-based decision-making can govern key activities such as the timing of spot and forward contracts, the proportion of exposure to hedge, and the prioritization of currencies based on the level of risk. For instance, Airbus, the European aerospace giant, routinely hedges a significant portion of its US dollar exposure, due to the fact that many of its sales are denominated in dollars, using forward contracts. By following pre-established rules, Airbus avoids emotional responses to market volatility and maintains stable margins, regardless of fluctuations in the dollar-euro exchange rate.